This is New York City Fire Department Pension Fund Investment Meeting. Today is 1/18/2012. It is 10 o'clock. We're at the New York City Controller's Office, 1 Center Street, room 650, New York, New York. We could have a roll call of trustees, Lee.
Roll call of trustees, Ms. Ramji Nagaswamy.
Here.
Mr. Larry Schloss.
Here.
Ms. Janice Amory.
Lisa Chan sitting in as a proxy for Janice Amory.
Mr. Stephen Cassidy.
James Levin has Mr. Cassidy's proxy.
And Mr. James Levin.
Here.
Mr. Robert Straub.
John Kelly has Mr. Straub's proxy pending his arrival.
And Mr. John Kelly.
Present.
Mr. James McGowan.
Here.
Mr. John Dunn.
Here.
Mr. James Lamonda.
Present.
Mr. Sean O'Connor.
Here.
Commissioner Douglas White.
Here.
We'll have 24 votes and a quorum. We can start the meeting.
Okay. Right.
Does everybody have their November reporting package? I won't bore you with the economic slides. Generally, they've all sort of bottomed and are bumping along the bottom or pointing a little bit upward. The only slide that I thought was sort of interesting is page 6, which is the weekly unemployment claims. And you'll notice it's slowly going down, but ever so slowly if you look at a trend. So I would tell you that's A, that's a good thing, and B, I think you'll probably keep seeing it, barring any major events. No idea as to where it's going to end up at the end of the year, but I think it's ultimately the economy is slowly recovering.
Larry, you think that's going to continue, notwithstanding what's going on in Europe?
Yeah. I didn't say it's going to boom, but at the end of the day, we're still the world's largest economy, and it's primarily service-driven. So if you just get a little bit of less uncertainty, people go back to their normal way of spending and borrowing, and you can slowly start to see it. Having said that, to your point, if you look at page 8, this recovery is the blue line. So you see the blue line is sort of just not going, it's pretty much flat. It is basically trending up for the last 6 months, but just ever so slowly, so it's just going to take us a lot of time. So again, as I said, I won't bore you with all this. It's hard to watch it on a month-to-month basis, but I think it's off the bottom.
Can I just do this globally, Larry? Because you're so right. It doesn't change much. It
Well,
doesn't mean it.
only if there's something dramatic. But I figure at the beginning of the year, we should at least start with a little once-over lightly, very light.
Yes, what's better?
And you will recall that once a quarter we bring in an outsider. We actually spend an hour or something going through the economy. We'll probably do that next month when they have the year-end numbers. I would like to point out page 20, which is for all the agitators reflected, and that's in the euro exchange rate with the dollar. You noticed last week S&P downgraded a variety of countries in Europe, not the least of which is France. And that's had a negative effect on the relationship between the euro and the dollar. But again, I think you're probably past the worst of it without a resolution, so it's muddle. Muddle's not good, but people get tired. It's amazing how insensitive people have gotten to bad things happening. And that's reflected on the next page, which is the VIX, the volatility of the U.S. stock market. If there ain't a crisis, let's just kind of get on with it. It's sort of how people are looking at things slowly. It's uncomfortable, and it can change on a dime. But all liquidity and all that the Fed is doing, as you can see on page 22, is people are trying to keep rates down. So again, the white line is where the yield curve was at the end of the year. The Fed said they're going to drop the section from sort of year 5 to 10, which they're doing. What's different, or what continues to be a problem for partly our portfolio, and partly why you're going to see the stock market, I think, move up, is the 10-year rate is now 1.84 and the 30-year rate is 2.9%, i.e. the Fed is saying we're keeping rates low, we're going to keep it low for the next couple of years, encouraging everyone to take more risk at the end of the day. Risk being defined as, let's say, equities or housing at some point. And you can see on the next page, 23, this has been going on for the better part of 6 months now. And you can see on 24, the high yield market backed up in the fall when the euro was front page news, and it's slowly coming back. I'll get back to what we've done about that in a little bit. Again, I don't want to spend a lot of time on this. I will tell you, if you look at page 29, these are the major stock indices, the Russell 3000, EFA, and emerging markets. And pretty much since things got a little crazy in August, there's been more separation than the prior, let's call it 12 months. Partly because of lags, partly because of euro, and partly because people are a little worried about how it all impacts the emerging markets. So what does that mean to us? If you go to page 31, this is the 12 months. And you recall that in the late fall, I guess during the summer or starting in the spring, we started to sell high yield. We got defensive, so we didn't have the same volatility as the markets. And in November, we're at 7.6. From November to about now, the markets have generally moved up, so I'd tell you we're probably at 7.7 or 7.8, which again is pretty damn close to our almost 8 billion peak, so that's all pretty good.
Why did you say it dropped in September? I remember. You talked about it.
Oh, it was the euro. It was all euro related. But again, the euro thing, it could flare up any second. They're trying to get the Greek discount right. Some of the lenders walked away last week, but nobody seems to care because ultimately they're all going to figure it out. So if you look, again, I would tell you we don't have the exact numbers yet, but these are November, so again, it's old. But I would tell you through the first half of our fiscal year, so we'll see the numbers next month, we're probably down less than 3%, which given all the noise, I would tell you is okay. Because I would also think that this current calendar year, the market should hopefully do better. So we'll be up. I don't know where it'll be June 30, but we'll all see. So hopefully that was the worst part of the year. I could be totally wrong. So don't play the video back. But as we sit here today, hopefully it goes up. And we didn't lose so much in the first half. And you recall on 33, we're moving from the old asset allocation to the new asset allocation. So we're going from page 33's numbers to 34's numbers. There's some bad numbers on 34. So the bad number is, if you look at the purple, which is high yield, which is down 0.7%, it's really plus 0.3%. So we're a little over allocated high yield as of November. Again, end of November we had 7.6% cash. End of December we're probably around 5%. The difference being we added 1% in high yield, so we're now about 1.3% over allocated high yield, and we added 1%, you may recall, in hedge funds that closed in December. So we're getting ourselves into the band, and as we all know, we're working toward the hedge funds, and we're also working toward the opportunistic fixed income, which is this, I guess, hot pink number with minus 4.5. We did a little bit of funding of some of the people that we committed to, so that's actually plus 3 from the minus 4.5. Martin assures me we're going to get some of these contracts done this month.
We've gotten some done, and we're going to get others done this year.
Right, so again, we expect to fund, we'll be well within that range by the end of the fiscal year, without a doubt.
Yes.
So we're moving along. We're a little over allocated in U.S. equities, but this page, and we're going to keep working on this page and the next page. This page is under the asset allocation. You'll recall that we have some parking places for stuff that were underallocated. That's not on this page, but it's on the next page. Page 35 shows you the rebalancing ranges and the adjusted policy targets. This page isn't quite right yet either. So we're continuing to rework this so that we can get these the parking places a little easier to understand, and I think we've shown them here.
It would be also great to simplify this page. This is in many ways the most important page for trustees. So if we can keep trying to simplify and take out stuff out of the footnotes, and it's just terribly complex, and yet it's so important. So
Right.
maybe split the pie charts into a different page, blow up the numbers, which I can't read with my reading glasses on.
Sorts of glasses.
It's just age.
Youngster.
It's just, exactly. You're testing me on many levels here, but I would appreciate your.
Yeah, it's a work in process
Yeah.
page. In fact, you're right on. We're going to have it be more than one page
Yeah.
because there's just too much information.
And we're working on that.
What are the parking places?
If you see the very bottom,
Yeah.
So this was approved back in December. So the parking places for opportunistic fixed income are 4+5 and high yield. Real estate is 4+5 and U.S. equity. Private equity is a mix of U.S. and non-U.S. equity, consistent with the mix that we have in real estate in U.S. and non-U.S. And hedge funds, the parking place is a mix of fixed income and equity.
and what you do, John, with those parking places is you take, if you go up to the very top column, it makes you have a new adjusted policy range.
That's what
based
an
on these.
adjusted policy target means.
Right,
We're
so
adjusting that because of the policy.
that's really what you would get to, and we're trying to make sure that we don't have any unintended consequences of parking everything. So again, this is still a work in process. Roger's right. This is kind of how we drive the bus. So it is the most important page overall, and we're going to try to make it simpler and more obvious. The same thing with the page prior. Again, the page prior, 34, is where we're trying to get to without the parking places. But the parking places are relevant as well. Anyway, all in process. So if you go to what happened on page 36 in November, it seems like a long time ago, but if you look at the second clump of numbers, November when had an outbreak of what I'll call the euro problem, and it infected all of the international markets. It didn't affect the U.S. that much, as you can see in the top block, and it backed up into the high yield market, which is the fourth set of numbers. Having said that, by the time you got to the following month, which is December, on the next page, 37, things sort of calmed down again. So the U.S. stock market was pretty benign. It was a little drifting down internationally. There was a little bit of flight to quality in the U.S. fixed income, and people came back to the high yield market. It continued both of those directions in January. So if you look again on 38, so for the month of November, which had those bad European international markets, we were down about 1.5. Fiscal year to date was down about 5. January has been good, so again, I think we're down probably 3% through the end of the first 6 months. And it's all driven by the equity markets. And it's all really driven by what's going on in Europe. It just tends to overwhelm everything else. The rest are all the manager numbers. Again, nothing too crazy one way or the other. I think the market's hopefully going to be a little calmer, so we can really see who's doing better and who's really doing worse on a more normal time. That's November. Questions?
All right, so if we have no questions, we finished performance reviews, right?
Yeah.
We need a motion to move out of public session to executive session.
So moved.
Second.
Any objections? Hearing none, the motion passes.
I know. Thank you.